Hello and welcome to your Recipe for Financial Success with me, Emma, and my colleagues Becky and Julie.
In each episode, we'll be bringing you a list of ingredients to help you cook up a storm and master methods to finesse your finances. We'll be helping you expand your repertoire and hopefully teach you a few new skills along the way.
So, clear the counters and get your mixing bowls ready for today's recipe. Let's get started.
So guys, are you looking forward to Spiky Ball Pilates this evening?
I am indeed. After our first session last week, I've got a bit of a taste for it now.
Ooh.
Had to rope me in as well, so definitely looking forward to it.
Your first time, Emma. Do you have any idea what you're letting yourself in for?
Not really, but I'm sure I'm about to find out. It can't be that bad, can it?
Your balls arrived okay?
They did.
No pun intended.
Oh, this is it. So, well, I think, Becky, it was your first time. What did you think last week?
It's really good. I really enjoyed it, so hence why I'm coming back for another week. So hopefully you will do too.
I'm sure I will.
Yeah, hopefully we'll do a bit on the back and the shoulders this week because that was really good the other week.
Yes, definitely. I'm looking forward to having a little bit of a back roll.
Anyway, this podcast is all about finance, not Spiky Ball Pilates. I feel like we've been ambushed here. So, Becky, do you want to introduce today's episode?
I certainly can. So in this week's episode, we are carefully measuring out all of the ingredients that we need when talking about asset allocation. So, Julie, do you want to start off by telling us a little bit about what asset allocation actually is?
I certainly can, Becky. And this is one of my favourite topics that we talk about in financial services and at work. Lots of pie charts and things like that.
Look how happy she looks,
She's
Emma.
far too happy.
I know.
I did say in the last episode, Julie said this is my favourite, and I said she would be in the hot seat, so here she is.
Yeah, as promised.
Absolutely. So I think one of the most important things is what is asset allocation? And there's a little bit of a misconception out there about what asset allocation is. And it's when we're referring to investments. And basically it's an investment technique which is about finding a balance within an investment by dividing your money into different areas and sectors, which can help to find the right balance for your attitude to risk. And hopefully that made sense to someone.
Yes, I think so.
So it's basically about when it's a split of your investments between different assets. And by having certain amounts in each asset class, that's what then helps the risk of your portfolio.
So when you say assets, are you talking about having so much money in an ISA, so much money in a pension?
Right, no. So that's products. So that's slightly different. So assets is when we're really getting down to the nitty gritty. So we talked about funds the other week, and basically funds is, we talk about different funds we're invested in, but within each of those funds actually sits inside an asset class. So if we look, for example, at a UK fund, it would sit under a UK equity asset class. If you talked about a property fund, it would sit in a property asset class. And also things like if you had something like a fund invested in emerging markets, so like Brazil, Russia, India or China, that would be sitting inside like an emerging market asset class. So every fund kind of fits within an asset class. So if I just go through some of what the asset classes could be, so for example, ones that we use are things like fixed interest. Mm-hmm. Equities, we normally split those into UK equities and what I'd call developed markets. Emerging markets, like I just touched on, which is invested in countries like Brazil, Russia, India and China, or BRICS, as it is more commonly known as in the industry. And also like property. And also cash. Cash is also there as an asset class, a very important part of everyone's portfolio.
So why is having the right asset allocation so important to an investor?
It is really, really important part of the of putting your investment together. It's a bit like, well, as you know, we all like a bit of a baking analogy here. It's a bit like baking into cakes. There's lots of different ingredients, and to produce the perfectly tasting cake that rises beautifully, you have a mixture of ingredients, and you may have to make sure that you've got the right amount of each one to get that to work. So it's really, really important to have the right split depending on what your risk is. So an example we have is, if you put too much baking powder in, it would make the cake rise too fast, which means when you take it out of the oven, it will sink and be really dense in the middle, which wouldn't be good if you looked at your investments.
Sorry, Julie, a bit like my Yorkshire puddings that I made at the weekend.
Yeah, those Yorkshire puddings.
And they didn't have any baking powder in them either.
Did you open the oven door too soon?
No, just a disaster.
I have a secret recipe for them later, Becky, that I'll share with you.
Excellent. If you could,
They
please.
win every time.
If
Not-
you could share that with me.
Not Auntie Bessie's, I hope.
Definitely not.
No,
All
definitely not.
homemade.
They just
Anyway.
don't taste the same. So
Sorry,
definitely-
Julie, to interrupt you.
No, that is absolutely fine. So
So what happens with your investment, as we've used a cake analogy, if there's too much of one ingredient in your investment, what actually happens?
it could just put out the balance. So the reason of having all your different assets and different percentages, what we're trying to do is give you a diverse portfolio. So it's when we use the word diversification. So what that means is if there's a problem in a certain area, normally in the world, if there's a problem in one asset class, you'll find that another asset class is doing well. And it just means by keeping it like a nice level, you find yourself not being overly invested in one area. So where if there was a big problem, you would find that your money would go down quickly. Whereas by having it quite diverse across lots of different asset classes, you're more likely to have a smoother ride and a less volatile journey for your investment within the market.
So you mentioned earlier a few of the different asset classes. Can you tell us a little bit more about each of those asset classes, what they are and how they work?
I certainly can. Do you want me to start low to high or high to low?
I think we should go low to high. Start
Okay.
off safe and we'll get riskier.
Okay, no,
Risk it for a
definitely.
chocolate biscuit.
So everyone would think, I guess, when we said about cash as an asset class earlier on, you think, yep, that's the lowest risk you can get on an asset class. And to some degrees, yes, it is. You've got your money held in a deposit type account, and it's very unlikely that you would lose your money. I mean, there's the risk of obviously the bank or building society going under, but the odds of that happening are very, very low. And you also have a protection of up to £85,000. However, you do have what we call a risk of inflation, which means that if your investment in the bank account in cash is not rising by more than inflation, then actually you are in terms actually losing money. So although you're not actually physically seeing that money going down, in that money spending power, you're actually losing money. And obviously with cash, there is no investment risk.
It becomes more worth less.
It's worth less, yes, definitely. And next one I would do is fixed interest. So this isn't like a bank account fixed interest rate, which you see like the NS&I ones and other building society and banks do. This is a little bit different. This is when we invest in things like corporate bonds, government bonds. So that's not just the UK government bonds. That could be anywhere across the world government bonds. So there could be an element of slightly higher risk there, depending on what country they're actually invested in. And also companies that sell their debt to the market, and which will give you a fixed interest. So it's a bit like an IOU. So, for example, if a bond is worth £100 and you get 2% each year for 5 years, the end they'll give you £100 back.
Didn't I hear they were thinking of doing negative bonds?
Absolutely. With interest rates so low at the moment, people are actually happy to be guaranteed to get marginally less back when they originally invested, which I may say is a bit bonkers, but actually they are out there and people are actually buying them.
I was going to say, are people mad? I don't want to get back less than I put in. I'm guaranteed to get less back.
Yeah, that doesn't seem like a very good deal to me.
But then if you've got it sitting in the bank account with the inflation risk, actually your spending power
It's going down anyway. I guess this is why they're the lower risk asset classes.
Absolutely, definitely. So, and I'll just give you an example. In September 2019, Apple went to the market looking to borrow £7 billion. And they basically got people to give them money, and then they are guaranteed that they would pay it back at a certain amount later on. So that's an example of where a big company is used for a fixed interest aspect.
I imagine Apple had quite a lot of interest.
Yeah, they were overwhelmed,
Yeah.
basically. There was a lot of interest. Apple's got a really good reputation. Obviously, my Apple Watch and everything. So
It's ping and dinging away.
it does ping a lot,
Go on,
actually.
Becky. Do you know how much actually people came after, though? So they wanted $7 billion, and how much were they offered?
Got to be, I would say, easily 3 times $7 billion.
Yep, you're right. It was at $25 billion. $25 billion.
So actually slightly over 3 times then.
So, and
That's
actually,
crazy.
Apple reduced the return they were offering because there was so many people trying to get their hands on it. They could actually lower what they were going to pay out because the demand was so high.
Just shows how much control these big companies can have over things as well by so many people wanting to invest in them.
Just because it's Apple, an Apple iBond.
I'm surprised they haven't got those yet.
Yeah, absolutely.
So what are the riskier ingredients that we can have as part of our asset allocation then?
So the higher end is equities or shares. And although we actually break those down a bit more into like UK equities, developed market and emerging markets.
So if we start off with emerging markets
are right at the top end. And that, I think I sound really excited when I talk about emerging markets, so I do apologise for. But they're the higher risk ones, and they're in the more what I would call interesting countries, which when I say interesting, it's because I like to go to weird and wonderful countries. Let's be honest, I did go to Chernobyl once. So, so they're in the countries which are considered not to be as developed, such as Brazil, Russia, India and China. And part of the reason they're considered high risk is we don't know as much about them as we do about places such as the UK or America, and they can be a little bit unpredictable. And certainly with China, with the statistics that have come out of China over the last sort of 12 to 18 months, how can we're not really sure how much we can rely on that.
That makes sense, Julie. So what about if you invested in developed markets? What sort of places would you be talking about in developed markets?
So developed markets, obviously the UK would fit under that, but we have UK as a separate category. But places like France, Germany, North America, Australia, those kind of places would come under what I would describe as developed markets. So the European countries, places like that. And in developed markets, it will be things like Tesla you'd invest in, Microsoft, PayPal, Facebook and Estee Lauder.
Some quite big names in there then.
Yeah, even I recognise some of those. Look, so...
So all these different assets and all these different asset classes, how on earth do you actually decide on an asset allocation?
Well, this is where it all gets a little bit technical. And
Julie gets a little bit excited.
So basically, I mean, I think a lot of companies, we all have different asset allocations. So different organisations do it. And basically, there's a lot of research done in the background of what works and what doesn't work. And it's not set in stone. It can change as well. So a good example of that would be the property asset class. So a lot of us we used to have in our portfolios at work, we used to have 10% invested in property asset class in the portfolio. However, since 2008, when all the property funds were suspended and people that didn't have easy access to them, that's actually dropped to 5%. And certainly recently in the last 12 months, with the property funds freezing again, there are some companies out there who are actually removing all their property asset allocation from their portfolios because of the illiquidity of the funds. So it does show that it's not, once you've got your asset allocation, it still needs to be looked at and reviewed. The asset allocation, though, is mainly measured on your attitude to risk. So depending on what your attitude to risk is would depend on how much you'd have of each asset. So we're talking about emerging markets being really high risk and like fixed interest being a lower risk. So if you were like a low risk investor, you might find that you have nothing in emerging markets, but actually have quite a lot in fixed interest or in cash. So, and then if you're like a higher risk investor, you might find that you then have quite a lot of emerging markets and perhaps nothing in fixed interest. So it's just kind of looking at how that works. So against your attitude to risk, the time that you're looking to invest the money for, and what assets you want to be putting them in. So it's quite
So I guess it's like a sliding scale. Depending on your risk, it kind of slides up the scale of how much you have in one asset class and
absolutely
down the scale if you're kind of a safe, cautious person.
Yeah, I mean, for us, we have a different asset allocation for each risk level, which makes it quite easy rather than trying to allocate. But then sometimes it's a case of, it's just making sure it's right. And again, like I say, asset allocation can change as you go along. So, and the reason we use a lot of different assets within the portfolio means that it isn't positively correlated.
Positively what?
Positively correlated. And what that means is that with the different funds, we're not all invested in all the same funds. So what you'll find is we use some software which we can put in the funds in it, and it actually produces what we call a positive correlation table. It's a real riveting read if you like a good spreadsheet, what can I say? But this will show us by investing in those funds how much money is invested in, for example, Apple across the fund, because Apple might come into a developed market fund, but it might also fall into like a tech category as well. So different funds may fall into different categories. So basically what we do is we look and see how the funds within the portfolio across the asset classes are actually correlated together. So the idea is we're looking to have a really, really diverse spread of funds and shares invested in. So we don't, if all our funds, if we had a client and everything was in fixed interest, you might find there's lots of crossover and lots of actual people invested in similar funds, which would be bad, because if the market went down in that area, then all their money would go down. Whereas when we've got it so the clients are not so positively correlated and there's a lot more like near the zero line, and therefore like lots of different ranges of funds, that means that everything would have to collapse in the world at the same time for the client to lose as much money. So by doing this, what we're trying to do is to give the portfolio the best chance it has to make money and not lose money.
So I guess when basically, really simply, when one thing's falling, you want something else to have the potential that it could be rising to kind of take advantage of kind of that kind of
absolutely
circumstance.
So back in the good old days, because obviously I'm really old, so I remember those good old days, whenever the stock market was falling, gold used to always go up. So having a combination was always good. However, now gold is not invested as it used to be. It's now paper gold rather than what I would call actual gold a lot of the time in the stock market. That's not a very good example, but back in the day, that was something that you could almost rely on. If the market was coming down, natural resources would go up. But unfortunately, it doesn't work like that anymore. So we can't just put everything in those and see what happens.
Don't they say that cash and like corporate bonds and government bonds and gilts have a similar sort of relationship to that?
They do, yes, definitely.
So a more recent example, I guess, of this would be last year during COVID. So when they were saying billions had been wiped off the markets and all the headlines were everything's losing money, if you actually looked at it a little bit more closely, a company called Premier Foods, and they make Mr. Kipling, I Do Like a Cherry Bakewell.
Oh, yes.
They're a bit sickly for me.
Are they?
Yeah, sorry.
Bisto, Sharwood and Bachelor products, their share price actually rose by 345% between the 23rd of March and the 16th of July. So that was probably more luck than anything from the point of view they were just really well positioned that people started stockpiling. We all saw that, especially the toilet rolls.
Yeah.
I suspect Andrex's shares would be an interesting price to look at in that time of February, March.
So it's just one of those that when everything else kind of in the market was falling because of COVID and all the hospitality had closed down and share prices in kind of the...
I need a bit more
Yeah, I was going to say I need more detail.
Like
hospitality?
the breweries.
Yeah.
So like Green King and all the pubs and things that were closed down, theirs were falling, but places like Mr. Kipling obviously going through the roof because everyone's at home enjoying a nice 11's cup of tea and a cake.
And also the other one was Zoom as well. Zoom technology. No one had even heard of going on a Zoom call like sort of 15 months ago. Whereas now Zoom is kind of, our new way of life. So no, definitely.
And while I struggled there with the breweries, I realised I've got written down a nice little airline.
You could have used airlines.
I could have done.
That's it. But I think that, as you can see, by the diversification, which I know I used earlier on, which basically essentially means don't put all your eggs in one basket, by making sure you've got a really good mix of asset allocation and you have different percentages. Not only does it look at risk, it also makes sure that you're basically spreading what you've got across the market in different areas. So in the event of things happening, such as COVID, which no one expected, but other world disasters and things like that happen, or areas that happen, like the tech bubble bursting, tech all went down, but other stuff went up. So it's just basically making sure that you've got a nice diverse portfolio, and asset allocation is a tool that we use to make sure that that's done really well.
Excellent.
Fantastic. And I'm sure if anyone's got any specific questions, they're more than welcome to get in touch with you, Julie, as you love asset allocation so much, and they can ask away.
Can I do like a coloured pie chart and everything
Yes,
for that?
you can.
Excellent. That's what I like to hear. Thank you very much.
Thank you, Julie.
And with that, we've completed today's recipe. We hope you have enjoyed following along with us today and cooking yourself one recipe closer to a financially secure future.
If you've enjoyed today's podcast, you can head over to www.recipeforfinancialsuccess.co.uk, where you can find out more information and a full list of ingredients from today's recipe. For more hints, tips and tasters, find us on Facebook at Your Recipe for Financial Success.
If you'd like to get more involved, share your own experiences and learn from a friendly community on a similar journey to you, why not join us in our new Facebook group, The Money Compass, where we will support you to navigate your way to financial success.
Thank you for listening and see you next time.